Welcome to the vlog, everybody. So, in this vlog in a car, I'll turn this down. In this vlog in a car, we're going to discuss emotions and investing. So, this is for, of course, the business-oriented channel. So I'm going to put it here. So, let me just give you the bullet points. Number one, when you are investing, which you should do, because most wealth is accumulated through investment, not through earnings, for most people. You got to invest, number one. So what do you invest in? You can invest in house. That's more of a quality of life, but most of the time houses go up in value. So, you're going to get some return there. Although house is not actually a very good investment overall compared to others. But in terms of quality of life, that's the main reason to get a house. But housing is an investment, your own house you live in. You can also get rental properties as well, which is another thing, but that's a business. That's a pretty steady thing. It's not 100%, it takes time. Typically it takes a lot of time to build up a housing portfolio that's profitable, but you can do it. The quickest way to wealth, of course, is through the stock market. Now, I'm not talking about individual stock picking, which is you can do, but that's a very risky proposition, a very difficult proposition for many reasons. Let me give you a few bullet points. First of all, most Wall Street investors, the professional investor class, the people who work full-time investing, most of them underperform, meaning they do worse than if you just bought the stock market blindly. Something called an index fund or mutual fund, ETF indexes. What's an index fund? It's simply you're buying a stock that basically has a bunch of tiny pieces of many companies in the market. Think about like an index of a book, or an index of a book is kind of like a summary of what's in the book. So an index fund is kind of like a summary of a bunch of companies. So you're getting a little bit of a bunch of companies. A little bit of Apple, a little bit of Microsoft, a little bit of IBM, a little bit of Pfizer, a little bit of Exxon, a little bit of, you get the idea. Now, there's different types of index funds. Some that will index the top 500 companies. Some will index certain areas. So you might have an index where it's just technology index fund. So it's just technology companies that it's comprised of. It could be an index fund of biotech companies or robotics companies. You get the idea. So there's a whole bunch of index funds out there. My suggestion to you, again, I'm not an investment advisor, so I can't tell you what to do, but what I've seen, that's a better way to put it, what I've seen that works, and most of the time, well, all the time, is that you buy index funds. Now, this is going to be tied back to the emotional issue. When you buy index funds, as opposed to individual stocks, which we'll get to in a second, but when you do buy index funds, you will take a lot of the emotion out of the investing, because the indexes move very slowly, but they do build over time. So you're going to have ups and downs in the market, but nothing crazy typically. But when you buy an individual company, you can have crazy swings, which could be pretty nerve-wracking. So if you do something silly, you have more than 10% of your investing cash in a particular business, a particular one stock, one company, that could swing, and that could be very nerve-wracking because you're like, oh my God, it's going up and down, it's going up and down. On the other hand, when you're investing in index funds, you probably won't get those big swings, first of all. Over time, you'll just get a steady increase. And so, because it's all highly diversified, it's far more relaxing, stressless, or stress-free, or stress-removing process. It's very important that you pull the stress, the emotions out of the game so you don't get scared out of your position, so you can live your life. That's the big thing we don't talk about enough. They talk about it, but they don't talk about it enough. One of the main advantages of doing broad index investing, broad blind investing, so you don't have to think about it, is that it takes the stress out of it so you can concentrate on living, concentrate on your work, on your business. You don't have to worry about that. But when you're individually invested, it can drive you bat crazy. I know, I've been there. So that's the number one thing about doing a highly diversified investment portfolio. Not just in stocks, by the way. You should have a certain percentage in stocks, a certain percentage in real estate, a certain percentage in bonds, a certain percentage in commodities. Maybe you can throw crypto into commodities, that pile. Now, what the percentage is, what the makeup, it depends on how old and how young you are, et cetera, et cetera, et cetera, how tolerant you are of the market moving. If you're pretty comfortable and a relaxed person and you're young, it would be something like 70% of your money in index stocks, 20% in bonds, and 10% in commodities like oil, gold, Bitcoin, that kind of stuff. But again, all in funds, all diversified. And 70 might be too aggressive. Maybe when you're 20 years old, 70. But when you get older, 30, 40, maybe you reduce that to like 60% in stocks. And you have 30% bonds and 10% in commodities, gold, oil. There are commodity funds you can buy, ETFs. You don't have to think about it. Why do you want to buy these index funds? First of all, you're highly diversified, because how do you know what's going on in a particular company? Are you an expert in the oil business? No, you're not. Well, you're probably not. Are you an expert in semiconductors? No. Are you an expert in AI? No. You don't know the business. So for you to be able to go in there and pick which are going to be the winners and the losers in that sector, in that group of companies, that it's gambling. It's gambling. So for example, the dot-com bubble, there are a lot of companies that shot up quite a bit, and everybody knew the dot-com, the web was going to be big business. Well, not everybody. Bill Gates thought it was just a fad, but a lot of people knew it. So you had a lot of these dot-com web companies that grew huge, and but a lot of them went bust. The vast majority of them went nowhere. So imagine you invested in one of these many companies that were in the right business, they were in the web business, but they went bust. How could you predict that? It's terrible. But if you're highly diversified, you don't have to pick the winners or the losers. You just grab that growth, So yeah, diversification also protects you from needing to become an expert in any industry. And you know what? You won't be. So, again, I can't tell you what to do because I'm not an investment advisor. It's not legal, but you just want to check these things out. So in terms of investing in ETFs, which is short for exchange traded fund, and you can just buy these like you would buy a stock, except when you buy an ETF, let's say the NASDAQ 100, there's an ETF. You're buying basically a piece of the top 100 companies in the NASDAQ. That's pretty good. There's an ETF out there called XBI, I think it is, and I'm not pumping it, I'm not telling you to buy it, I'm just using it as an example. Again, I have to say that because I am not an investment advisor, but that particular ETF basically tracks all these biotech companies. So the biotech is going well. If you think biotech is going to be good over the next 5-10 years, then instead of trying to find a good biotech company, just buy one of these ETFs and you just forget about it. You sleep well at night. The key here is you got to sleep well at night. That's the theme of this video. People underestimate the importance of the psychological impacts of being heavily invested in a particular company where all your chips are there. Very dangerous. And it's hard to sleep at night. So I want you guys to sleep at night. So there you go. I hope this video is useful as we're driving around the city this Sunday morning. But yeah, well, I wanted to stress in this video that one of the reasons you want to have a very diversified portfolio, some stocks distributed amongst ETFs or funds that are low-cost funds. For example, take a look at Vanguard. There are probably others. And a little bit in bonds, a little bit in commodities. Why you have it diversified like that? Because you don't know who's going to win or lose. Wall Streeters don't know who's going to win or lose, and they have all the information. A, and B, you want to be diversified in different sectors, not just all stock market, not just all bonds. Why? Because if the stock market goes down, typically the bond market goes up, so it kind of balances things out for you. So if it all goes to hell in the stock market, you got your bonds to protect you, Why did I say that when you're younger you can have more investment in bonds and less in more investment in the stock market, less in bonds? Well, because stock market typically goes up faster in value than bonds, but bonds are typically stable. They're safe. Bonds are just basically you're involved in lending money to companies and governments. Yeah, so they're just more stable, and because they're more stable, even when there's economic downturn, they tend to rise in value because people kind of buy those. And, anyhow, so that's the story with that. So you want to have a mix of both bonds and stocks. If you're younger, you can put more money in stocks because you have time. Because if, let's say, the market crashes, which happens every now and then, eventually it goes back up, right? It could take a year, it could take 5 years, but it goes back up. So if you don't need to retire for 10 years, 20 years, 30 years, then you might as well just buy more stock market, you know. But yeah, as a general practice and rule in life, you want to be diversified in everything you do. All right, I hope that helps. We'll talk soon. Bye.